Hello and welcome back to the third weekly review of the Forex markets. So today we're going to be jumping straight into it. So with what we were looking at over last week, we were expecting a lower DXY due to all of the problems with the labour market, and we thought, we were pretty set on a rate cut coming. So if we have a look at the daily chart. Now, it's been very, very choppy, and this was expected pretty much all last week that we said, until NFP numbers come out on Friday. So, and as we can see, the move really did happen on Friday with a big drop. And even though it's still pretty consolidated, I think we are still just going to hold for a lower dollar. Now, I don't really want to go into too much technicals because it's pretty choppy at the minute. Let's be honest. We've been, over the past couple of weeks, we've marked out this order block. We tapped this, and we've just been pretty much range bound, which doesn't yield a good return day trading, because how can you predict the next daily candle within this? However, for a swing trade, this is it's okay to hold trades within this if you're positioned correctly. So if we do actually pull up Forex Factory, because the markets aren't really showing too much at the minute, we can have a look at last week's numbers. So if I just go to where was it now? Here we go. So leading up to the week, we had unemployment claims last Thursday, and these were the two news drivers, the unemployment claims and the NFP numbers, that were really being looked at by big institutions. As with Powell's comments on a rate cut, this was mainly driven by the fact that the labour market was actually suffering, and it was going to be these two data reports really that were the last two keys of the puzzle to see how they were doing. So unemployment was expected, it would forecast at 230. It's come out just slightly higher than that, which shows that we were expecting bad unemployment, and this has actually come out as true, if not even a little bit worse. And then on the Friday, NFP 75 was expected, which is already quite a low number if you go back on Forex Factory and maybe look at a couple of years ago before COVID levels. This was actually much higher, and then we've actually had it come out, and it's 22k, which is very, very low, and it's much lower than expected, which is quite a surprise, really. We knew things were getting pretty bad in the labour market in the US, but this just adds more reason to cut rates. So this is just, again, in line with the bias that we've been holding for 3 weeks of a lower dollar. So if we actually have a look at the FedWatch CME group chart that we've been covering over the past couple of weeks, the big question was either no rate cut or a rate cut of 25 basis points. And now this chart has changed from the rate staying the same isn't even an option now. It's now 89% in favour of a 25 basis points cut and 11% in favour of a 50 basis points cut, which is a quite significant change from what we've been looking at. This basically shows that a rate cut is guaranteed as far as sentiment is concerned. So we're definitely looking at the 17th of September and what that will bring. But this is quite damning, It showed that we've got a very good sentiment building now for a lower dollar. We have over the past couple of weeks, we were looking at the labour market data, which has come out and shown us that, yes, we are in line with that. It's pretty bad. NFP numbers have come out bad. Unemployment is, just higher than expected, which, again, shows us that it's bad. And then now we can see the sentiment is building for whether the question will be a 25 basis point cut or a 50 basis points cut. So how does that translate into the charts? Even though we've been pretty range bound, I don't expect to see expansionary moves higher on dollar now. And if we do expand slightly higher, it'll just mainly be to run out stops in this area. But I can definitely see that these targets right here are pretty much, in my opinion, ready to go on a daily chart. So if we were to use this information, I don't know, how many of you guys are sort of got an idea of what's going on technically, but I'll just point these lows out as intermediate targets for the next couple of weeks on the daily chart. Which, how can you use this information? If you know that you're expecting expansion removes to mainly go lower, then you can intraday target just bearish setups. I would not be looking to take any longs on the dollar, especially when the macroeconomic environment at the minute is just not good for the US, which means that we can't really be looking for longs, as we just know that those moves aren't going to be favourable. In conjunction with this, if we have a look at the bonds market, we can see that NFP numbers have pretty much come out, and labour market numbers, unemployment, and the bonds is starting to dump pretty hard, actually, much harder than the dollar has held up. So as we can expect now, the dollar will follow the bond market, as investors will look to take money out of their dollar investments because they won't get as high a yield on that investment, and they will start pouring it into different assets, which is why the bonds is a good confluence to our trading idea of a lower dollar, and that definitely shows that now people are pulling their money out of the bond market. If we go to the Euro USD and GBP USD, I have said that I only favour longs from here, and we've pretty much, if I just take out these drawings, we've been coming up and we retraced pretty hard. I actually had my fib marked out. I believe I marked that out last week on one of the commentaries, but we've been exploding higher, and now I expect just longs on both of these currency pairs. They're pretty much the same. The only thing to note on a 4-hour chart maybe would be that we had some SMT here. This was a higher low, and this was a lower low, so I would maybe look to trade the euro in the up and coming weeks over the pound, just because the euro has underlying strength. So we want those expansionary moves in line with our trades, which is why I'd probably be looking at euro. Now, if we just check on the swing trade I've been in since I started making these commentaries, the USDCHF, I'll just put the drawings back on screen. Yep, so this was my entry, a previous week's high sweep. I've covered this in both of my commentaries, but now we've been chopping around, and it seems to be that Friday was the big move lower, and that currently was a 5.5-hour target. If I just add the position in just to see where we're currently running at. I didn't expect this high to go. We're currently running at a 3R. So we're currently 3R, but with the macroeconomic environment, you've really got to make sure that those winning trades or things that you believe have started to go more and more your way, especially with unemployment data, NFP numbers, the sentiment from the CME chart. I don't really see any reason to cut this prematurely. One bit of advice that maybe I could give that I've learned from seeing people is, when you're in a winning trade and things seem to explode in your direction, then this is usually a sign that you've got in early and that you're actually in line with the overall sentiment and bias. And if you're in early enough, you can hold for much longer, and you really need to hold that to make sure that your returns are as good as they possibly can be. Because looking at this trade here, where we entered is positioned really, really well, and we shouldn't really get back up to this level at all. So if we do get back up to sort of break-even levels, I don't want to be in the trade, because that means that something is, massively changed that I didn't expect. So once you close a trade, let's say I closed it at 3R, where do you align safely in all this chop? You can't really position your stop loss in a safe area within this. So it's definitely worth, once you're in a trade, focusing on that trade, rather than just sort of, trying to always find positions with lower stop losses. You kind of want to keep that stop as safe as possible, manage it properly, and I'll be keeping a close eye on all the data and reports that come out just to make sure that I am, managing this effectively. And I will only ever cut this trade or sort of take profit when things seem to start to turn against me. Maybe there's some more positive numbers in the US, or I've got to a position where I can't, losing what I've got so far wouldn't make sense. So I'm pretty comfortable at the minute. I'm happy to hold the trade. I am only looking for a lower dollar over the next couple of weeks and months, unless anything changes. So I see no reason to sort of get out of this trade. And, once, this is break even now, so you can scale into different trades. Sort of if Euro USD sort of has a weekly protraction into this area and starts to expand higher again, I will look to realign and add to my position just to sort of scale in with half risk. As that's a nice way to make sure that you can risk the most on the first trade. Once you break even, you can half risk the second trade, and with that, you have now got let's say you risked 1% on your first trade, 0.5% on the second trade. If you can get them in line, you now have 1.5% moving in your direction and only 0.5% risk on the trade, which is actually, a really nice way to build that equity curve in a strong way. So that's pretty much it, to be honest. I think that's what I'm mainly focusing on. I think the swing trading is definitely a slower approach. There's nothing too much intraday. It's definitely been quiet in all this chop, so there's nothing really to break down. We pretty much got what we expected with NFP. The sentiment is building behind all the ideas of a lower dollar, and for the main takeaway from this is just look for short setups, ensure that your stops are in a safe place, and just manage effectively. I do believe or forecast that over the next week now, we will start to get some movement towards the downside rather than just being in this chop, as the data has now made it pretty much cast iron that a rate cut will come, and there is no reason to sort of wait anymore for the larger investors. Now, if we go to the next week, just to look at what news we do have coming up, we have core PPI on the Wednesday. Tuesday and Monday are very quiet days, and we have CPI on the Thursday, and then Friday is just some consumer sentiment stuff. So main expansion, if you're intraday trading, I would expect the second half of the week to be the expansionary moves, with it really kickstarting on Wednesday. We do have CPI on the Thursday, which this has been a thing that I will just cover quickly, that people have been inflation is pretty bad in the US at the minute, and that's partly some of the reason why they have held the interest rates so high and rather than cut sooner. And that's been sort of their contrasting thing to the labour market. So almost like a bit of a stagflation thing, where they don't, inflation is going higher, but the labour market's getting worse. So they can't really decrease the rates because the inflation will get worse. But they do, the labour market's got that bad now that they need to sort of change some policy and get involved before things get worse. So if these CPI numbers come out lower than expected and inflation is actually easing, then that is just another confluence for a lower dollar. So, again, if this comes out soft, I imagine to see some pretty explosive moves in the DXY lower. So I'll definitely be keeping an eye on this Thursday right here to see what news comes of this. So that's pretty much everything for this week's commentary. I hope you have enjoyed and found some stuff insightful. If you are an intraday trader, just stay patient, because this chop is, sometimes you have the narrative, but the technical side isn't in line with that, and you just have to be patient. And I've seen a lot of people getting burnt throughout the month of August just in this chop because they want to go lower. But, when there's no technical setup, that's part of your edge. You need to ensure that you're protecting that capital, because once we start moving down lower, you need to be in a position where you've still got chips at the table to play. And this is definitely one of the reasons why I've liked swing trading in the past couple of months, because I've been aligned, I've sat in the chop, and I've gotten out of placing any trades in this sort of area. So thank you very much for watching this week's episode. I hope you found it valuable, and I hope you have a safe week trading.